Hi, so this week I'd like to talk a little bit about the low options volatility environment that we're in. A lot of people are noticing that we've been trading in a very tight range in the market, and as a result of that, options volatility has come way down. The VIX is now at about the lowest levels it will normally get. There have been some outliers, but basically the 9 or 10 level is extremely low options volatility on the VIX. And this can be actually very positive. For many traders, this has been a very good year because that low volatility is helpful to us as far as our positions. Once we get in them, if the market stays in a low volatility regime, as I've talked about in other videos, you can make some good money that way. On the other hand, there's a downside, and that is that these conditions create a higher than normal level of danger. And that danger is created by the scenario where you enter a trade in a low volatility time and the market sells off hard, and all of a sudden options volatility blows up substantially, as it did on May 17th. One of the sharpest rises in the VIX I've ever seen, actually, from a percentage standpoint. And that happened because we were in a super low volatility environment, and people, whatever was the news event that day or whatever caused people to get scared, all of a sudden options volatility spiked substantially, causing most people's positions to really suffer that day from an unrealized P&L standpoint. So these are more dangerous times. You're paying more for your debit spreads, you're getting less for your credit spreads, and therefore you will end up with more risk on the table with less reward, essentially. So in butterfly or iron condor trading, which are both negative vega trades, both of those trades suffer when volatility increases, and it creates this dangerous situation which I mentioned. The short options in these positions blow up disproportionately to the long options. You get this big suppression of the P&L because of the fact that your short positions have just expanded, greatly in value, therefore hurting your position. So here's a little tip. It's just a tip. It's one of many, many ways of solving the same issue when you are structuring your trade initially in a low volatility time. As many of you who are watching this video are familiar with John Locke's M3 trading strategy, and the typical structure of an M3 is a long, deep in the money call, and then a put side butterfly that's bearishly positioned in the market, creating a pretty flat position. And a typical M3 structure that you might enter today for July would have 432 points in negative vega. However, if you restructured this position so that your deltas were the same as the traditional M3, but instead you got rid of the long, deep in the money call, and you pulled your wings in so that your deltas were equalized, you'll notice a drop in options volatility down to, a drop in vega down to negative 407. So that's a pretty nice drop, given that it's the biggest Greek in the position when you first enter it, simply by making that one modification. Now, let's see the modeled effect of this if the market were to sell off down to 1370. Right now, the Russell 2000 is trading at about 1395. So this would be, let's say, a 25-point drop. All right. If we model 2 points of additional options volatility in the M3 structure, the model would show us a loss of $2,600 if we drop down into that 1370 area. On the other hand, in the broken wing butterfly structure that we laid out, the loss is cut down quite a bit. It drops to 1900 in that same scenario. So you can see that's a substantial amount. What is that, about 25% or so reduction in P&L with the same deltas, just by structuring the trade a little bit differently. So it's fairly powerful when you need it. Now, does this modification have no implications other than that? No. Otherwise, everyone would trade that way. Well, there is an implication. One of the big implications is you've reduced your time decay, your time premium that you're short on the trade is less. And in fact, that's why it responds less to an increase in options volatility. The theta at the opening of this trade has been dropped by 15%, for example. So the trade's going to be less rewarding to you. But in a low volatility time like this, you may want to be thinking about that eventual, big sell-off in the market that will come at some point here. And when that happens, you'll be a little bit happier that you were in a broken wing butterfly structure than an M3. We've noticed on our options trading desk, the traders who are much more careful about risk management are the ones who succeed in a more sustainable way long term. As I've said before, these trades are built to make money. They're going to make money in most environments. So the key is controlling the losing months. If you can do that in different ways, by controlling deltas, by controlling vega, you're going to get a leg up long term in terms of the continuity and the sustainability and the consistency of your success. So this is just a little tip. Take a look at it, back test it, see if it's something you want to make your own as a way of modifying things in different environments. I think it's got a power to it that you should consider in your trading. Thanks very much, and we'll see you next week.